Welcome all to the Private Equity Playbook webinar focusing on construction. To get it going, today we'll be focusing quickly on a round of introductions so you can get to know Scott and Andrew a little bit better. Then we're going to get into a trend discussion talking about current state of the construction industry, and then looking forward will be the majority of the conversation. We'll save some time for live Q&A at the end. Please feel free to send through your questions into the chat throughout the entire conversation, and I'll make sure we get to those at the end. And then we'll spend a few minutes with closing remarks at the end and chat about where you can connect with Scott and Andrew and the rest of the Grata team. I will be your host today. My name is Phil Coughlin. I work here for Grata as a sales director. I've been in the tech industry for about 10 years, and I'll be hosting today. I'll kick it over to Scott for him to introduce himself.
Good afternoon. I'm Scott Mitchell. Normally I don't sound like RFK, but today I do. I've been a little under the weather, so trying to do my best impersonation here. I'm with SDR Ventures. We're a middle market and lower middle market investment bank based out of Denver, Colorado. Been around since 2002, exclusively serving founders and entrepreneurs with a major emphasis in industrial manufacturing, industrial services, and in particular, construction and infrastructure.
Thanks, Scott. And Andrew?
Good afternoon, everyone. Thanks for joining us today. We're excited to be here and have a great conversation with Scott and Phil. And hopefully you guys get something out of it and have some good questions at the end. I'm with August Cove Capital, and August Cove is a very new boutique lower middle market M&A focused firm based in Canada, and looking at cross-industry, mostly sell-side advisory in Canada and US.
Thanks, Andrew. Where the industry stands. So M&A activity is soaring within the construction industry. And in particular, tons of growth through markets like California, but especially the South too, like Texas and Florida. And so with that in mind, I'll kick this first question to Andrew. What are some of the macro level trends like remote work or AI that have impacted the construction industry over the last few years?
Yeah, it's there's been a lot, and obviously COVID has been the massive one, as well as a lot of monetary debasement, printing, interest rates. But remote work has really reduced the demand for office construction and led to more adaptive reuse projects. So this is like office to residential conversions. So that's a big one. We've seen suburban growth accelerate due to people leaving city cores, boosting residential and infrastructure construction to build out these new areas. And then AI explosions really fueled demand for data centers. And I know Scott's got a lot to say on data centers that I'm looking forward to hearing. But this is a really big topic, and I think everyone's just seeing it everywhere now. It's driving significant investment in specialized construction projects. So this has been something that's happened over the last few years, and is going to, I think, play a really big role in the industry and driving investment and capital coming up for the next 4 years as well.
Yeah, I think, as Andrew pointed out, there were a lot of things coming out of COVID that really had a major impact on the construction industry, supply chain challenges among them, right? And so we saw a massive emphasis on building new warehousing, right? People were just stockpiling inventory, right? So, and Amazon thought that we were going to be 50% e-commerce, by 2025 as far as end markets, right? And so just building massive warehouses. And so I think we've seen in 2024 that dissipated quite a bit, right? That um, those warehousing installations retracted quite a bit. Um, I think we've seen major demographic shifts. To Andrew's point about remote work, um, we represented a company last year that was supplying high-end windows and doors to mansions in Aspen, right? And the growth in Aspen has been absolutely incredible. With the average home sale price is, I think, north of $5 million, and a bunch of $30 million mansions. It was a little bit depressing. I was selling this company and looking at what their products were, and a typical project they would sell the windows and doors for more than my whole house costs. But these were some of the things that we saw were major drivers over the last several years. And I think we're entering a new phase, right? I think the dust is really settled on COVID, and we're entering a new phase.
Yeah, absolutely. And then maybe, doubling down here, what are some of the really interesting niches in the construction market that have emerged over the last few years, Andrew?
You know, going back to data centers, right? So, these that's been a massive winner, and that's kind of a niche that's emerged now. It's not necessarily, related to COVID or anything. But all these things kind of work together. So, AI cloud demand keeps rising. So that's been something that's come along during this time, and it's going to continue to strengthen. And then, as I mentioned, kind of this office to residential conversions is kind of a niche that's come up as we've realized we have way too much office space, in every city across the world, and we don't want to be living in tiny boxes in the sky, as much as we wanted to before. As much, as fun as that is, maybe when you're 20 in New York, but when you have kids and stuff, and you realize, space is nice, and maybe nice weather is nice, and lower, taxes or no federal taxes is nice. You want to move elsewhere. And then these are left vacant, right? And so a lot of firms are looking at redevelopment of these office spaces, right? And so there's firms looking at redevelopment for, let's say, greenhouses and things like that. But the larger movement is for living space. So that's a very interesting niche, and I think that's a winner that's come out of it. And then on the losing, side, losing momentum, there's, commercial office space in, let's say, suburban areas was hot for a bit, as you have people moving out to the suburbs, but they still need somewhere to work. They just want to be closer to their, new home, with rather than going into the city, right? But they're not trying to work out of their home necessarily. So that was hot for a bit, and then it's kind of uh, petering out a little bit, because remote is still very popular, and people are just making use of their homes more, rather than even going to that office 3 blocks away from their home. Um, and then retail construction also, like in these suburban areas, is strong, but slowly kind of losing momentum. And then speculative real estate development, that was really hot when you have free money, low interest rates. You got to be, investing in something. People are throwing money around looking for investment properties. So there's a lot of money thrown around in speculative real estate. And, as Scott's mentioning, Aspen is growing, and maybe these are second, third, fourth homes, maybe they're investment properties. That's been really popular, but higher rates, and especially since we could be stuck in a higher rate environment, are challenging for that type of speculative development. And then if we see some sort of recessionary pressure, tightening of credit, that could really impact those projects. And that's the first thing that goes, right, is kind of the speculative interest.
Yeah, I would just piggyback to say one of the areas that we've seen a significant shift in building products and the type of buildings, right, is within the metal building space. Um, they become significantly more attractive. You used to think of metal buildings as really just barns, sheds, maybe, just very simple warehouses. And I think we've seen, higher quality steel. The supply chain is a little bit easier than the wood industry, the natural products industry with timber. Um, we've, I think people are more, there's a realization that metal buildings, may withstand natural disasters to a greater degree than wood, right? And so that's one of the things that we're seeing. We're working with a client right now. Knock on wood, deal will close in the next couple of weeks here. But they build metal buildings for government, for um, stadiums, things like that. And it's a private equity deal, right? And I think that's a deal that private equity would have struggled to get done even 5 years ago.
Yeah, thanks, Scott. And you talked about some of the significant shifts in building products. So I guess to shift to more looking ahead versus the current state, and with the new Trump administration, maybe Andrew, you want to talk about a little bit some of the risks to the industry, how changing policies around environment or tariffs might be affecting the construction industry.
Yeah, this is I think this is my favorite topic here because it's happening right now, right? And it's changing kind of minute by minute. So I don't know if everyone's been watching tariffs like I have nonstop for the last 48 hours, but we've seen tariffs implemented and then there's been delays, pauses, right? Negotiations. So, current is there's a pause on tariffs, right? From US to Canada, Canada to US, and Mexico, same in terms of US. Pause, in terms of negotiations going to be happening, and we'll see if these are actually implemented. They likely will be, at least we should expect they will be, and could be in place for a long time, maybe a year, maybe longer. And then, of course, tariffs on China. So these are massive, massive in terms of their impact on the construction industry as well as other industries. But uh, these, like tariffs specifically, I mean, these are going to increase the cost, right? The cost of materials for the industry. And we'll have to watch that play out. All we know is that things are going to cost more. Inflation's is going to increase. Supply chain disruptions are expected. So this is just going to cause massive, massive waves across the industry and completely wreak havoc on supply chains because, US construction depends on Canada, depends on China. Canadian construction, same thing, a lot of product from US, Canada. So everything's interrelated, and now we're kind of breaking everything up and forcing companies to, rethink their vendors, rethink their supply chains. So that's going to be really huge impact. And then you have immigration policies, right? So massive shift from Biden's administration for immigration, deportation happening, going to be a lot harder for immigrants to come into US, likely Canada also, later when there's government change. So when you have less people coming in, I mean, it's going to slow down development, right? Especially in these areas that immigrants have been coming into. And that's suburban development, right? Infrastructure. So that's going to slow things down. It's also going to be have a major impact on cost of labor, right? Cost of skilled trades, skilled labor. Uh, that is already a shortage, so that's already a massive problem in the industry. It's going to be a greater shortage with less immigrants coming in. Typically, a lot of them, would take a lot of skilled jobs in the construction industry. So labor crunch is going to be very serious, again, leading to inflation. So you have cost inflation of materials, you have labor inflation. So just the price of building things is going to go up, right? And then you have all these additional administrative, operational costs related to completely, redesigning your supply chain and finding new labor sources and dealing with delays. So those two are really huge from a policy standpoint of what's happening right now. And then there's the rollback environmental protections regulations. So I mean that's going to hit energy energy. Well, it's going to be a positive for infrastructure, and a lot of projects are just going to get done faster and less red tape. But there's also this step back from energy infrastructure, renewable energy infrastructure. So that'll be a huge impact on that sector in terms of government incentives and just stepping behind that industry and moving along to some of these climate goals that the Biden administration had. So a lot of uncertainty and a lot of things that are very critical for the industry happening right now. And then you have on the financial side, removed from well, slightly tied to administrative change, but you have the backdrop of high rates right now, right? High rates. You have inflation that's still elevated. It's probably going to rise more in all the ways it matters for construction, and uh, you have potential credit tightening happening. So it's a very different environment overall right now than it was, 4 years ago, 3 years ago, where a lot of spending that happened was due to favorable policy for infrastructure spending, very low interest rates, a lot of money just flowing around looking for a home, a lot of immigration happening, so a lot of need for new development to support population growth. So a lot of complexity here as the industry stands this moment.
Yeah, one thing I thought is relevant to touch on is under the Biden administration, right? The CHIPS Act, the Inflation Reduction Act, um, actually stands to create a bunch of jobs, right, in red states, in the construction industry for alternative power, alternative energy, infrastructure, et cetera. Um, one of the worst marketing jobs in history was Biden not really touting um, all that he was doing, right? And so actually, you have now red state politicians sort of surreptitiously uh, with Trump saying, "Hey, we actually really want these jobs, right? We these bills and this money was actually going to be really important to us, right?" And so I think it still remains to be seen. Yes, less maybe regulation that's sort of dictating um, move to renewables, move to clean energy, but at the same time, um, I think these what the previous administration did. I think if Trump wants to keep his base happy, he may not want to tear all of it down, right? I think then, as Andrew mentioned, as we think about where we're headed with AI and data center, right, and just to put a few facts on the table. Um, Last year, data center spending increased 60% year over year. Okay. Um, Data centers consume roughly 10 to 50 times the energy that a commercial office building uh, consumes. Um, right now, maybe 1% of our electric grid goes to power data centers. By 2030, depending on what estimate you read, the International Energy Agency says by 2030, around 13% of global electricity could be consumed by data centers. Greenpeace said maybe 20%, right? I mean, that's massive shift. Um, and frankly, our grid is old. You know, our uh, our grid really just can't handle these power needs, right? I mean, and so that's going to be a significant bottleneck, and um, it's going to create a massive demand for new innovation and new construction within the power and utility industry. So there's, um, I think you have like on the one hand, you're going to have labor constraints with deportation, unskilled labor. On the other hand, if a lot of white collar jobs are potentially displaced by AI, which was, counter to what we thought maybe 3 years ago, right? But it looks like that if you sit at a desk and you work on a computer, that work is actually more easily replaced than than wiring a building. And so, skilled trades, the need for skilled tradesmen is going to go up, and those jobs are going to become more attractive and necessitate higher pay.
Yeah, Scott, great points there, and just to add on a little bit to your point on, there's short-term policy impact right now for renewable energy projects and renewable energy infrastructure, but that's not going away. It's still, we need renewable energy, right? As you mentioned, I mean, 20-30% of total, usage going through data centers. I mean, Bitcoin mining is going to take a lot, right? So we keep finding new uses for energy, especially cheap energy, and so we're going to need that, and so that's not going away. And there's still pockets, massive pockets of opportunity in renewable energy infrastructure, and the space, specifically in solar, I think, that are going to drive a lot of capital investment, even in the current policy environment that's uh, really favoring fossil fuel energy infrastructure and projects.
Thanks, Andrew. And I want to go back to the conversation on tariffs. There have been a bunch of questions that are all kind of the same question in the chat here. So they're asking for you to follow up, Andrew, on how you think that tariffs are going to impact the international M&A, cross-border deals. If you have.
Yeah, great question. Great question. And yeah, I wanted to talk about that. I think that's a huge opportunity, is going to be created for cross-border M&A, right? You have companies, let's say in Canada, that are going to be impacted heavily by tariffs, right? And that could create huge opportunity if these companies are not able to stay solvent, not able to deal with issues. Maybe the owners decide to just walk away, kind of they don't want to deal with this, or the company's just not positioned to deal with it, right? So they're much more open to sale, especially at, let's say, fire sale or reduced valuations to, let's say 6 months ago, a year ago. So opportunity to pick up, especially with the foreign exchange. So pick up cheap assets in, let's say, Canada or other, countries that could be impacted by this, even Mexico, right? So for US acquirers to pick up, with a strong currency, cheap assets in Mexico or Canada. And then on the Canadian side, if you're, or the Mexican side, if you're a company that's going to be impacted by these tariffs, it could be interesting to acquire, a company in the States, or have a subsidiary in the States that you could potentially use to avoid, these tariffs and shield yourself a little bit and change, where you manufacture or where you source materials. And so that's, I think, going to drive a lot of interesting deal flow, whether it's forced sales or just opportunistic acquisitions. Again, trying to solve these problems of labor and supply chain. So that's going to, I think, drive some good deal flow. Generally, though, I think deal flow, I think M&A activity will come down over the next, let's say, 4 years versus what it has been over the last 4 years. And that's really just related to, where the world is. I mean, we went through COVID, and that situation, what happened there in terms of the amount of money that entered the system, really changed incentives. I mean, it forced some pretty quick growth. Just the fundamentals forced quick growth in the industry. And so you saw not only business fundamentals improve, even though they could have been temporarily, but there was big margin expansion in certain sectors, and huge, very pointed demand and very fleeting demand increases in certain sectors that are gone now. But those drove a lot of M&A in terms of companies looking for growth that were stale, and they found companies growing. And, if they were public companies, you saw valuations really skyrocket, because you have cheap money and usually you buy assets, whether it's, real estate, stocks, those kinds of things. And so with cheap money and low rates, assets go up. You have very expensive public stocks, cheap paper. You can use that to acquire private companies, large multiple arbitrage there as well. So that entire environment that just happened, and that, in one of the slides we have, you could see a massive spike in M&A activity in 21, I think. Um, that was pretty abnormal. And I think we could slightly come off. I'm not saying it's going to disappear, but I could see a slightly weaker M&A environment, especially because of all this uncertainty right now. I mean, COVID was a lot of uncertainty for about maybe 6 months to a year, and then everyone seemed to say, like, we figured it out. Everything's going to be okay. It's just a lot of money in the system. Let's go do stuff with it. And now we're really not sure where we are on the financial side, rates, money entering the system, money leaving the system. And then on the tariffs, not sure how this is going to impact valuations, but uncertainty typically means less activity, unless it's in specialized pockets like, M&A driven by solving supply chain and specific policy introduced problems.
We cannot, there are certain things coming from Mexico and Canada. We simply will not be able to produce here in the United States, right? We just don't. And to scale up production will just take too long. So, I'm still of the mind that, like, with the Super Bowl coming up, to use an analogy, is this play action, right? Are we faking a handoff to the running back and then we're going to throw the ball, right? I mean, is that really what we're doing with this tariff policy stuff? Because, I'm still skeptical. I think a lot of people are, right, that it's really going to be as dire as we think, or as it could be. Now that being said, if these tariff policies do come to roost, it will drive overall consumer prices up, right? And so, what that ultimately means for our economy, right? I think it's too early. What it means for deals, I would say it's a little bit early, right? To really know, right? And how do the tariff laws work? Does it matter where the company is domiciled, versus where the production is actually done? I think all of those things will play in. I'm probably maybe not as bullish on, not as bearish as Andrew, on construction M&A activity over the next several years. I think private equity has always struggled with how to play in this space in different ways, right? And I think over time, and even through COVID, maybe getting a little bit more creative around how to play in the construction space, whether that means, look, the classic LBO model with, 5 to 6 times leverage, probably doesn't work. But if you over equitize, you create, just more equity-like structures within the debt stack. I think that's what we're seeing. That because there's not enough good asset-light deals anymore for private equity. So people have to figure out new ways to invest. And I think knowing how much infrastructure investment there has to be, I think there'll be significant deal activity within commercial construction, and maybe, new construction, right, has always been sort of a dirty word for private equity. If you're tied to new construction, I'm not saying that that it's still not going to be scrutinized heavily. But I would say um, they're getting more comfortable in certain industries where there seem to be pretty significant tailwinds.
Yeah, just to add to that, Scott, it's uh, great point, and yeah, I wouldn't say I'm bearish necessarily on M&A activity. I just don't think I could see it come off a little bit. But to your point of private equity involvement, I mean, the industry is still extremely fragmented, right? You have so many players, extremely fragmented compared to the industry in other countries. And so a lot of room for consolidation, right, across the board for across every sector. And we've seen a lot of consolidation for the general contractors, trades and building material manufacturers. There's been a lot of activity. Um, I think one sector is coming back to renewable energy and solar, is the solar space, solar installation. So this is like a really small subsector of, let's say, construction, but solar installation, like specialty solar installation or residential. So this is, commercial business, residential. It's even more fragmented than your generic kind of than the rest of the industry. So a lot of small players. There's been a massive kind of land grab and just relationship kind of building and brand establishment over the last 10 years, but it's still extremely fragmented. We don't see a lot of activity from private equity in this specific kind of niche of the construction industry, this solar installation space. And I think it's going to continue to grow. And I think there's a lot of room for private equity to consolidate here, to come in, pick up, small companies, piece them together, get some brand power, get some scale. We don't really have any huge brands that really have that kind of clout. And even ones that, are Canada, US, Mexico, right? So like international solar installation companies. Huge opportunity there uh, that is not being taken advantage of. And I could see that becoming kind of a key roll-up play for private equity coming up over the next 4 to 6 years.
Yeah, thanks, Andrew. And we'll do Q&A here in a minute. So I see more and more questions firing in. Maybe in the interim, we'll do a little rapid fire. Scott and Andrew, do you guys have some big winners and losers as you look out over the next few years for the construction industry? Maybe we'll start with Scott here.
Yeah, I mean, we talked about the data center space. I mean, it's just going to be massive, and again, that's going to have a cascading impact into the power grid for sure. So I think if I were to highlight one winner, that would be it. I would say the other winner, and I say this, tongue in cheek, but cataclysmic weather and natural disaster events, right, are going to um, continue to create, uh, more and more need for reconstruction, right? And rebuilding infrastructure. And so, whether it's fires, floods, um, just severe weather events, right? I think we're seeing that the overall um, uh, strength of some of these events, right, is increasing and growing. And so we've seen a ton of activity, and I think we'll continue to see a ton of activity in restoration, um, cleanup, and then within reconstruction as well.
Yeah, that's completely agree with those, Scott. And I had kind of four on my list here. But data centers is number one. Don't need to get into that one any more than we've already have been. And then to kind of piggyback off the last comment, I was talking about solar roll-ups. I mean, I think specialty solar installers and then fossil fuel infrastructure. So companies involved in those sectors, I think will do very well, as well as companies that are adopting robotics and AI in the industry. No matter which sector they're in. I think that's going to really help drive efficiencies when they can't necessarily, let's say, control costs on the material side or on the labor side. So as much as they can, gain in their control through AI and reduce their workforce, and robotics, those are going to be the winners in 4 years. And I think that's going to be massive change when it happens. It's really slow. Construction's slow to adopt, technology in general, but those will be big winners. And then firms converting, any player that is involved in the conversion of offices into residential and mixed use spaces, whether it's, they're manufacturing materials, special materials for these types of reconversions, or whether they're actually, general contractors, doing the work, or project managers design, anything related to that, I think it's going to be very much in demand, and they're going to do very well.
Awesome. Thank you, Andrew. All right, I think we should move to the Q&A. We have a bunch in here and some really good questions. This one's from Ron, and maybe we'll go to Scott first. And it's really about he's asking about the political swings every 4 years. How are PE firms thinking about that? Is that worked into their expectations and valuations? How are they changing the somewhat constant changing political landscape?
Yeah, it's interesting. I think the almost every election cycle, presidential election cycle in the United States, you see a slowdown in deal activity right before before an election, right? And we saw that in 2024. We saw it in 2020, in 2016. And then right afterward, you actually see a spike in activity just simply because there's a little more certainty in the system about, what the next 4 years is going to look like. I think right now, the the sentiment is high, right, around, as Andrew pointed out, fossil fuel production. Um, the reality though is oil and gas is always going to be just a highly cyclical industry, and I don't see, there's some firms that are comfortable with it, most are not. I don't see any new firms getting comfortable with it, to be honest with you. Um, as far as I think some of those things, there's so many trends that really rise above, right, whoever's in power. And I think the need for our grid to get updated is just so dramatic on it doesn't really matter who's in office, right? If I think commercial needs within technology, are going to drive more investment in our grid, so I think that's one of the trends that would go beyond sort of the cyclical nature within an administration. So it's really hard to say, right, until you really sort of drill into a specific subsector, right, in terms of how is private equity going to look at it. Private equity has always struggled with residential construction. I don't see that changing, regardless of who's in power. It's too volatile.
Thanks, Scott. Yeah, a follow-up question here around somewhat similar topic for you, Andrew. How do you expect the building products distribution and general contractors to perform amid this new political and also economic environment?
Yeah, great question. I think it'll very much depend on the specific companies, right? Rather than blankets of, how will building products manufacturers, fare. It's more of, where are they? Where are they manufacturing? What is, who are they selling into? What type of product is it, right? Like, is it aggregates? Is it, finished product? Is it for residential? Is it for commercial? So I think the answer, how will they fare is dependent on, 5, 6 things of, can they figure out, can they control their costs, right? Can they control their supply chain? Can they deliver on time? Can they run on time? Can they figure out labor? And are they delivering the right products, right? Are they manufacturing the right products? And then, how dependent is what's the price elasticity, right, for their product with their customers? Because we're expecting inflation, and can their customer sustain inflated product, right? Like inflated pricing for that product. Is it that much in demand? Can they pass on that price inflation to the ultimate buyer or consumer, right? So that's what it'll depend on, I think, in terms of the product that will fare well is product that's going to go into this, let's say reconstruction or redevelopment. I think finding those niches where very specialized product is needed and there's less price elasticity of demand will be very important. And then, of course, there's for acquirers, there's going to be looking at businesses considering all of these aspects, but finding those that are maybe severely impacted by the current environment and looking for really good deals there, picking them up and then doing some restructuring and repivoting of the business.
Thanks, Andrew. All right, maybe a fun one for the last question here to you, Scott. Would you recommend that a high-end residential home builder in the Northeast sell now or wait for a better opportunity?
A high-end residential home builder, right? Real estate is hyper local, right? It's so dependent on what market you're in, right? And so what my recommendation, from whoever's asking this question is really to understand, demographics, right, in and around your city. So, just to give you an example, right? In this, I know this is not residential, it's commercial, but the idea is to sort of, that hopefully the idea translates, which is, I live in Denver, right? Downtown Denver, and again, this is commercial office, but effective vacancy, meaning like not just who's not paying rent, but like if they are paying rent, are people actually there, right? But effective vacancy is as high as 40% in downtown Denver. Okay. Less than 10 miles away in Cherry Creek, vacancy is 2%. Okay. And buildings are going up and it's frothy. And it's been a gold mine, right? And so I would say generally the same thing applies, to your residential as well, right? If you're in an area with strong demographics, meaning good net in migration, income levels are rising. It's like you said, if it's high end, right? If for instance, right now, if you're in Chicago, right, and some of the higher income suburbs, it's really not a very good place to be, right? It's very constrained in terms of being able to build new, and there's no reason to build new because there's a lot of people looking to move out of Highland Park. So I don't have a good answer for you other than the demographics of your market will really dictate whether it's a good time to sell. And we always say, look, you got to sell at 10 o'clock, not midnight. Okay. So if you sort of wait till the peak of the peak time, right, it's too late. You're Cinderella running out of the ball. Your chariot's turning into a pumpkin. All right. So that doesn't that applies more in residential real estate than almost anywhere, right? So if the market's good right now, it's not going to last forever. So it's probably the right time.
Thanks, Scott. We're just about at time. So maybe, I guess, first and foremost, thank you, Scott and Andrew, so much. Pretty much everyone who joined has stayed through the entire webinar. So clearly this has resonated with the folks in the audience. Andrew and Scott, maybe Andrew to start, where can folks find you?
LinkedIn's the best place. It's got all my contact info, and shoot me a message, and happy to connect.
And Scott?
Yeah, our website is sdrventures.com, and I'm S Mitchell at sdrventures.com. Love to chat.
All right. And thank you all for joining. My name is Phil Coughlin. If you have any more questions about Grata or the Grata Deal Network, where you can access live M&A opportunities, just reach out to me on LinkedIn. I hope everyone has a great day. And thanks again, Scott and Andrew.